There are different mortgage repayment types out there, and it's important to know the difference between them. So, today I'm going to give you a brief overview of some of the different mortgage repayment types and the most common ones that will crop up when you're looking for a mortgage. Now, one of the most common repayment types that isn't as mortgage repayment types is something that you need to consider and you need to know about when taking out a mortgage. There are different types of mortgage repayments, and in today's episode, I'm going to talk you through some of the key information regarding the most popular options that is out there. The first repayment type that I'm going to talk to you about is the capital repayment mortgage. This is the most common mortgage repayment type, and it's the one that ensures that the mortgage will be repaid at the end of the term if you keep making your monthly repayments. Now, this is the most common because there's the least amount of risk involved. Because if you are making your payments every month and making these payments on time, at the end of the term, your mortgage will be fully repaid. However, unlike the other options that's out there, this is also the most expensive mortgage repayment type. However, it is the only one that's going to guarantee that the mortgage is paid back at the end if you maintain your monthly payments. The next mortgage repayment type that I'm going to talk to you about is the interest only mortgage repayment type. This proves to be, and it was extremely popular a number of years ago when endowment policies and pension policies were being used to repay them, and when interest rates were extremely high back in the 90s, interest only was a very common way of financing your mortgage and your home. Nowadays, it's typically reserved to a niche set of clients, and it's also reserved to things like buy to let lending, where landlords are looking to maximise their income from the property. The interest only mortgage, it does give you a lower contractual cost, so a lower monthly cost. However, because you're only paying the interest back, it means that the capital will remain outstanding at the end of the mortgage term. With this type of mortgage, there is a greater risk of negative equity. So, if the house prices come down the way, you will be at risk of negative equity. And there's no guarantee that you'll be able to pay it back at the end of the term unless you have your separate repayment vehicle or repayment strategy set up to do this. The third and final one that I'm going to talk to you about is the part and part repayment. Now, this is a combination of both interest only and capital repayment. It reduces some of the risk because some of the mortgage will be repaid at the end of the term, but it's still risky because that interest only element is there and there's no guarantee that this will be repaid. This proves to be an option that's popular with people who tend to have a low basic pay, likes of car salesmen, for example, who've got a lower basic and a larger bonus structure. They tend to take the part in part to reduce the risk down, reduce their monthly cost, and then use the overpayment allowance on the mortgage that they've got. In summary, the most popular option in the market and the one that comes with the least amount of risk is the capital repayment mortgage. It's the one that I'm talking to most clients about, especially first time buyers, people looking to move house. It is the most common option. Interest only does remain quite popular in the buy to let market and the rental market because it does allow the landlords to maximise their monthly cost while building up a cash reserve from the profit that they're making each month. And it also keeps the contractual monthly commitment down should the property remain empty. I hope you find this useful. And if you do, please don't forget to give it a like and a share. Cheers.